I'm going to cover support material 4. That's the focus for tonight. I will go through some of the examples in the actual study guide. You will see that the study guide is pretty much covering topics relating to income and what forms part of income, purely because we need to determine how much are we going to be paying tax, and the only way we can do that is by looking at income that we derive as an individual. So we're looking at support material 4, TAX2601. First bit, just some recap from last week. Last week we spoke about 4 different forms of ownership. We spoke about a sole proprietor or a sole trader. That's one individual running a business independently. Then we looked at partnerships. Partnerships are taxed the same as sole proprietors. They're also taxed as individuals. So each partner will have to register with SARS, and they will have to pay their own taxes on the portion that they receive from the partnership. Then you have a CC and you have a company. CCs, you can't register new CCs, but existing ones will continue to operate. The existing CCs that still survive today are treated like companies, and you get 2 types of companies, public and private. From last week, we know they're separate legal entities. What does that mean? Well, those companies or those businesses will continue forever as long as they continue to manage their finances and they operate sustainably. They'll continue for many years, longer than any of the people will survive. Okay, obviously we spoke about some examples of companies that have been around for many years. If I just think of one, something like Coca-Cola, all right, very big company that has been around for many years, and you do get others as well. Even other companies that are more, let's say, in a specific field, like General Electric. I'm just thinking of like American companies. From a South African point of view, maybe we can talk about South African breweries, okay, before they were bought over by the Brazilian company AB InBev. But something like South African breweries have been around for many years, and there are other examples as well. Why is that important from a tax point of view? Well, the key thing is we need to look at the rate of taxes that those people have to pay. We know that tax in this country, in terms of a company, is set at 28% as a flat rate. Flat means you're going to pay 28% on the first rand that you earn and on every rand thereafter. There are special classifications. Tonight we're going to be looking at those details a bit more summarized in terms of what the actual textbook speaks to, in terms of the criteria. The small business corporation gets taxed according to a sliding scale. So that's a progressive tax system where the more you earn, the more you pay. Micro business, the big difference with micro versus small business corporation is with micro, you're only going to be looking at turnover. And that was the biggest advantage here for a micro business because it reduces the administration burden. No one likes doing admin. So one of the major factors to consider here is, well, if I conduct business as a micro business, so long as I meet the requirements, it's going to make it a lot easier for me to comply with the rules and regulations around how much tax I need to actually pay towards the government. Okay, obviously in chapter 1 and 2 we were looking at background. You know that tax is government's form of income. Without tax, the the country isn't going to operate, and that's why they have companies tax, and that's why they have VAT, and that's why they have estate duty. They have so many different forms of tax, and the reason for that is to collect money for the government in order to provide us with public goods and services. This is the checklist for an SBC or micro business. This I've actually taken from the study guide. They give you a column, okay, for the requirements, and then they show you what you need for an SBC and a micro business. Remember, this can be reviewed and changed annually depending on the budget speech. They might perhaps review this in terms of the 20 million or the 1 million, and you just need to look at what your textbook says currently. So when we look at examples, in the examples they'll mention the requirements in terms of all the shareholders need to be natural. Natural meaning they have to be individuals, people, okay, not businesses. So a company cannot be a shareholder in an SBC or a micro business. That wouldn't meet this requirement in terms of being a natural person. So natural meaning it has to be you and I, okay, a human being. we need to hold shares in that company, okay, in that small business corporation or in that micro business. Also, something important to note is that we don't hold shares, meaning you can't hold equity in other businesses. There should be none. If you do, you're not going to meet the requirements for an SBC or a micro business. Right, and the reason for that is this is looking at very small businesses that are starting or that have been around for a few years that are still growing. And remember, we said last week that government needs to encourage those businesses to grow, because without small businesses, the economy would look a lot worse than it currently is. For example, not too long ago when they were talking about the budget speech and they were looking at the state of the nation, where Cyril Ramaphosa gave the speech regarding where are we currently as a country, one of the big things that he spoke about, and he still talks about it, if you just follow him on any form of social media or news or any good channel that provides information regarding what's happening currently, you'll see he always talks about job creation. And that's one of the big problems that we have as a country, is that there aren't enough opportunities for people to have jobs. A job is one form of employment that you can consider. There are others as well. And that's why government tries to support and motivate people to try start businesses. Because if we have more businesses around, those business people can then employ other people. So instead of having to compete for jobs in terms of, well, there's only a certain number of jobs in a particular industry, we can either all fight and apply and try get those jobs, and that is very competitive. So if that's the case, great. That's one way of seeking some form of employment or seeking some form of work. The other method would be, well, to start a business or to create a business or to build a business. And that's what government is trying to incentivize here. And that's the only reason why they give these incentives, is to try and encourage growth. If we get more entrepreneurs starting businesses, so for example, you're an entrepreneur. If you're a successful entrepreneur, then there would be one other job that could be maybe offered to someone else who might not have maybe the skill or the know-how or the ability or the will to start their own business, and then they could have that job. So it all depends. Government is obviously trying to make the country better for everyone, and the only way they can do that is by helping small businesses grow, because hopefully small businesses can become big businesses. All businesses start somewhere. Even the biggest companies in the world started somewhere. Companies like Apple, companies like Amazon, they started literally in the garages of Steve Jobs and Jeff Bezos. And obviously those companies have grown and grown and grown and grown, and now they've become massive companies, global companies, and they're obviously employing many people around the world. So that's the reason why government is trying to incentivize small business. The only reason why they do that is to try help everyone. Okay, by helping small businesses, you can help citizens, because that creates more opportunity. Gross income or turnover. Remember, gross income is looking at this, SBC. Turnover is looking more at that in terms of the micro business. We saw the tax tables last week. We'll see them again. Investment income. There should be none. Private company, yes. And in terms of year end, it can have any year end for an SBC. For a micro business though, the year end must be the same as an individual. And if you remember correctly from last week and the week before, obviously we're looking at 1st March to 28/29 Feb. That's the tax year for an individual. So as long as the company, in terms of being a micro business, has met all those requirements, you'd fall under that category. And if you fall under that category, we saw last week that the benefits are quite high in terms of saving on taxes that you might have to pay in terms of the income that you derive. So let's consider the budget speech. It's been quite a while since the budget speech came out. We're obviously in like mid-March already. So the budget was delivered toward the end of February. So that's around 3-4 weeks ago. So I don't know how much of the budget speech you had listened to. If you did, could you think of something that was good, something that was bad, and something that was maybe ugly in terms of the budget speech from what you heard? Okay, obviously there's a lot of news and reports about it, but The point is that you can't please everybody. Some things are good for the country, some things are not so good for the country. That's just the way that the budget works in terms of having to create plans, okay, in terms of taking certain action to try achieve certain things. So one of the big things, I know you asked me last week about the free higher education thing, if I remember correctly, and that's obviously a good opportunity for people studying, because that creates something that they can maybe use as a tool to take opportunity of, all right, to move them maybe into a different area. Right, so yeah, I definitely agree. So the good, financing study education, definitely. The bad, increasing VAT, possibly, okay, but remember, the government needs to raise capital, so if they don't raise certain taxes, they're not going to be able to fund certain projects or areas. So the main reason why VAT probably went up was also to increase the amount of money collected, because without the additional money that's collected, they wouldn't be able to do as much in terms of projects. So that could have been part of the financing that they did in terms of education. The ugly, not so sure. Well, again, that's subjective. So I don't know if you're a smoker. I don't think you are. But if you were a smoker, or if you're, let's say, if you drink a lot, perhaps, that might be something, let's say, ugly that you're not really going to like, is sin taxes. Okay, something as simple as, well, paying more for wine, paying more for beer, paying more for cigarettes. Yeah, so you're not a smoker, you're not a drinker, so yeah, you're more healthy and obviously you're living a healthier life. Yeah, smoking and drinking, well, depending on who you speak to, might suggest certain things in terms of, well, what I've heard is that drinking a glass of wine a day is actually quite good for your health, but yeah, smoking does have some really harmful effects in terms of cancer and other diseases. So yeah, right, so again, it's just a matter of perspective. That was the only reason why I put the slide up. It's perspective. What do you think about the budget? Because you can speak to different people and everyone has a view. Obviously, depending on how the budget has affected you, you're either going to view the budget as being good, bad, or ugly, depending on the situation. All right, so it's purely discussion here. Great, so now we're looking at study unit 4, which is income. If I look at the word income, what comes to mind when you see the word income? Like, if you had to give me another word for it, what would you say? Yeah, just type it in the chat and then I'll say what you've mentioned. Income. What comes to mind when you see the word income of a business entity? Money you get or profit. Good. Definitely. Income, if you look at the definition from an accounting point of view, they're looking at something like an accrual, where money is going to be recorded when it's earned, or even when it's received, but the receipt isn't as important as when it's earned. That's probably the biggest thing that the accountants look at, is that whole accrual basis of accounting. In tax, you're also going to be considering that as well, because the government really doesn't mind when you get the income, as long as you've got the income. So if it's earned, you're probably going to have to pay tax on it. So it doesn't matter if you've received it or not. And we'll look at the definition. We'll look at how they actually define it in terms of being a form of income. And you do get different types of income. So be careful how you, let's say, classify certain things. Later, you'll see something called like exempt income. So income is still income, but some forms of income can be exempt. And then you get other forms of income that has to be specially included, special inclusions. Meaning, it's not quite income, but the government, i.e. SARS, is going to view it as a form of income. And that is something to consider as well in terms of like special inclusions. So income is quite a broad concept. Obviously, in this particular unit, you're going to be looking at the definition of gross income. See, again, another specific definition of income. Income is income, but now we're not looking at net income or exempt income. We're looking at gross income. So gross income, obviously looking at a higher level. Right, and then obviously we'll look at special inclusions. Exempt income, we'll discuss what those are in this chapter tonight. Alright, so I've got a few short questions here. Again, just because of the audio and limitations around the connection tonight, maybe just to ask you to participate through the chat, if you can maybe consider the first one. An individual company renders a service. Will tax be paid on his income? What do you think? Yes or no? Perfect. Yes is correct. Any individual, any company, doesn't matter who, juristic or natural, if they render a service, there's going to be some form of tax paid on that income. Remember, we said tax is kind of universal and constant. It is something that we just have to comply with. All not companies, all countries do it. There's nothing unique or special about South Africa in terms of our income tax system or our tax system in general. All countries need to collect taxes from their citizens. And that's why if we're earning income, government is going to want to tax that. They're going to want to collect in order to help build the country. The second question, an individual company disposes of a non-current asset. Will tax be paid on this income? What do you think? No, we wouldn't be taxed on money received unless we are disposing of a machine or something like it. Okay, when you say no, the thing is you are going to pay tax, but it's not really a form of income. It's more a special inclusion, because if I'm looking at a non-current asset, that's actually looking at a capital gain, a taxable capital gain. And that's a separate chapter. We're not going to be looking at capital gains tonight. It is covered in your module. Later on, not this week, probably the next week or the week after, we'll be touching on this concept in more detail. But it is definitely part of the consideration. It is something that the government, in terms of SARS, will consider, because they will definitely want to collect some form of tax on those assets. Because think about buildings and land. Depending on areas. So for example, Sandton is obviously a very, very, very popular suburb, and in terms of property and land and buildings, right, the land and buildings could be worth millions. And obviously if people are buying and selling those assets, well, that's a transaction that SARS would want to collect taxes on. Okay. So they are fair, because they are only going to tax you on the capital gain. They're not going to tax you on the nominal value of the transaction. Right, so that means, for example, if the building is worth, I don't know, 100 million, and the building gets sold for 100 million, they're not really going to tax the full 100 million. It's normally only on the gain, because someone would have to have bought that building before they would have sold it. So they are fair in terms of not unfairly taxing the citizens, okay, or companies. They do tend to try keep it as fair and as equitable as possible. Right? Obviously, we want a system that taxes everyone fairly. We should all pay a fair share of tax. And the last one, is there a difference between the above two transactions? We've been discussing it. You said no, both accruing income. Yes, one is rendering a service and the other is disposing of an asset. You're right, because there is no real, let's say, distinction other than, well, are we going to be taxing the income according to capital gains, or are we going to be taxing the income according to income tax? So you're right in terms of income being income, a receipt being a receipt. It doesn't matter how we got that income. If we sold property, that's a non-current asset, that could be a disposal, or whether we rendered a service. We've still created some form of value. And that value is generally going to be taxed, but the rules at which they get taxed will differ. And that's pretty much what I've tried to give you here in terms of that thought, that introduction. So just remember that study unit 4 is only dealing with what? Income. It's not dealing with other forms of tax like capital gains. Right? You even get other forms of tax like pay as you earn. Right? That we've discussed previously in terms of an employee. If you work for a company, doesn't matter how big or small, and you're deriving some form of salary or wages, you are actually going to be paying a form of tax on that income, and that's obviously called employees tax. So just remember that study unit 4 is looking primarily at this whole concept of income, and income that's specific to a business. So if I'm running a business, what could we have as income? The most common ones would be service income, okay, or services rendered. So money that we derive from providing a service, or the other one, sales. We're not really going to be looking at other things like earning a salary or a wage. Right? A business can't earn a salary or a wage. A business can pay salaries and wages, but they don't earn it. And that's what Study Unit 4 is looking at. So just keep it focused on companies, businesses, not people. All right, then the last 3 questions here. Can we get different types of income? We've already actually spoken about that, so I'll answer that one. Yes. Last week, we touched on this, resident versus non-resident. Will all income be taxed the same? That's a nice easy answer, or easy question to answer. No. Okay. Not all will be taxed the same, 100%. Right. We know that different taxpayers have to follow slightly different rules. They still have to pay their fair share of tax, but the rules differ slightly. And that's something important to remember. So just to give you some tips and advice from a test or an assignment point of view, when you do tests and assignments, you need to try identify what section am I looking at. Am I looking at section 1 in terms of study unit 1, 2, 3, or 4? And then if you can put your mind in that like category, then it kind of helps you when you approach questions, because you'll see when they do test you on these topics, they tend to pull questions from different sections, and then you just need to apply the applicable legislation. So you need to apply the right rules. That's the key. The last one is, how do we know what income is? There's always a definition. When we, the company, are accruing money or in favor of any sort. Yeah, you could look at that. It's kind of like the definition. You'll see the definition here later. Before we get there though, just to yes, definition in S1. S1, what is S1? Study unit 1. First chapter. Oh, section 1. If you've gone through the information, okay, if you are looking at the actual Income Tax Act in terms of legislation, remember the legislation gives you all the rules. And remember, government, in terms of parliament, they create that legislation. They create the rule of law, basically. And then SARS is responsible for implementing and collecting the taxes from its citizens. Right, remember, we spoke about segregation of duties, and that is so applicable here, because the rule body, okay, the rule setting body, the government, parliament, they should set the rules, but they shouldn't also be involved with the collection. It should be kept separate. There should be a segregation of duties that sort of creates the least problems in terms of monitoring, in terms of oversight, in terms of compliance, in terms of making sure that things are done correctly. Okay, so just a quick definition here. What is a resident? What is a non-resident? We've actually looked at this before. It came up in one of the previous slides. Quick question, how do we determine if a person is a resident or non-resident? And we're obviously going to be focusing more on this. Juristic, i.e. a company, rather than an individual. I don't know if you've done the other tax modules. There is a 1501, a 1502, and those tax modules tend to focus more on individuals. So if you are an individual, how will you be classified as a resident or a non-resident? That's something that can be considered here. That's not what we're looking at though here. What we're looking at here is how is a company going to be viewed in terms of its business's operations. Okay, so a company, a CC, or a large corporate, how are they going to be classified? Are they going to be resident or are they going to be non-resident? That's what we're actually looking at here. So what do you think we're going to use to determine if they're a resident or non-resident? What would be some of the factors, the key considerations that you would have to look at when making that distinction between a non-resident and a resident? What would you say we would have to look at? It's quite an open question because there's quite a lot you could look at here. If it's mainly business operations, admin-wise, and held in SA, definitely. Okay, yes, you're right. So when it comes to a business in terms of its HO or HQ, the headquarters, head office, headquarters. Right, so the headquarters or the head office of a company is key when SARS is looking at this whole idea of resident versus non-resident. So juristic persons, companies, are residents of the Republic when they meet the following criteria. Number one, incorporation. Incorporation means where did it start in terms of being registered. So you've probably registered with CIPC because you mentioned previously that your photography business is running as a company, okay, a private company. So that tells me that you definitely have documents that you've registered with CIPC. Right? CIPC obviously looks at maintaining the records of companies in the country. Right, so if I'm operating and I want to create a separate legal entity, it's almost like getting a birth certificate. It's like when you were born. Okay, when you were a child and your mother gave birth to you, right, your mother and father would have had a birth certificate to prove that you were born on this day in this country, and you weighed X in terms of weight and how big or small you were in terms of size, etc. Right, and that's what they kind of do with this as well. Right, so if a business is going to be registered, they talk about it as being incorporated, i.e. established or formed. If the company was established or formed in the Republic, you're probably going to be seen as a resident. Or, and there is an or means alternatively. Right, so let's assume that we weren't incorporated. So let's say we were an American company. Right, an American company that was incorporated in America. Right, something like McDonald's, okay, or KFC, or Coca-Cola. Right, all of those fast food outlets and food and beverage companies, they're incorporated outside of this country. Right, McDonald's didn't start here, but they operate here. So now, what SARS is going to do is they're going to look at this. Where is the place of effective management? Okay, you'll see what I mean by effective management later on. I give a little bit more depth in terms of trying to bring in some of the legislation just to give you an idea of what it looks like. And they talk about the legal aspects to it. So, for example, what determines effective management? Right, remember, previously in, I think it was week 1 or 2, we spoke about the importance of case law. And we spoke about the law of precedent. Right, why do we need those things? Well, the main reason is for this. It's to establish some sort of system whereby the past can influence the future. And that's why if you are a lawyer, you need to always be up to date in terms of current cases that are either in court or that have had certain judgments. And the reason for that is judgments that come out recently can affect future cases. That's why lawyers have to stay up to date. That's just the nature of their business. And the reason for that is to stay relevant and to apply the rule of law correctly. Because according to our rule of law, any past judgments or any past cases, depending on what areas they're in, can affect future cases and future judgments. And that's how the system works. So the same thing applies here in terms of looking at SARS's practice notes or interpretation notes. You probably remember this from last week as well. We spoke about like burden of proof, and we spoke about interpretation notes in terms of practice notes. Okay, another word for this would be a practice note. So remember who sets the rules in terms of law? Who sets the rules? Who makes the rules? Parliament, government, exactly. And then who implements the rules? South African Revenue Services, 100% SARS. Right, so having looked at that previously, there are certain interpretations that need to be communicated because SARS is going to have to administer the rule of law. And the law will state certain things, okay, and then it's up to those people that are practicing law to apply the rule of law correctly. And that's where interpretation comes into it. And that's why we have so many practice notes and interpretation notes from SARS. I did think this was quite interesting, so I included it just out of interest's sake. I haven't actually seen them test this in too much detail in this particular subject, module, because it focuses primarily on this, a business. This is looking at the debate between a non-resident and a resident. And if I'm looking at a natural person, remember natural person means human being. Someone not a company, not a CC. And if that's the case, you might be interested in determining whether you are a resident or a non-resident. And both have their pros and cons. We've seen this before in terms of what we mentioned on a previous set of notes. If I'm a resident, I'm going to be taxed on my worldwide income. Right, that means if you're a resident of this country, and let's assume you've got a business in another country, you would have to pay South African tax on all the income, whether the income is here in South Africa or not, so long as you're considered a resident. If you're a non-resident, well then it's a little bit more lenient, because then you only pay tax on a South African source, i.e. what comes from this country, from RSA. Anything that comes from the country, as long as you're considered a non-resident, only what's coming from the country will be taxed in the country. And that's how the government applies this whole idea of people that maybe travel perhaps and do business abroad and do business in different countries. They need to have a system whereby they can apply the rule of law. And there's two tests that they normally do. The first is an ordinarily resident test. And this is quite a nice one to consider, because it looks at someone's almost like belief, if you will, or their home, basically. It's where do you consider your home? Right, do you consider South Africa your home? Meaning, if you had to travel across the world, right, where would you return from your wanderings? That's what they describe here. Okay, the word wanderings are described there. Meaning, if you travel anywhere, where do you eventually basically come back to? If you always come back to SA after your wanderings, that would be considered your home. And if we're looking at this test, you would be classified as being a resident, meaning you don't have a choice. You have to pay tax on all your income anywhere in the world. That's how that works. The other is looking at physical presence test. Physical presence test speaks for itself. How long have you been inside the country for? Right, so they normally use like a 183-day rule. Okay, we're not going to go into that into detail. You said place of domicile, place which you said to come back to not matter where you go in the world. No, not quite. Domicile means more where you where was the company created. So domicile would be like, where would you consider the inverted commas like head office? So like yeah, so just be careful with this. This slide is looking at a resident versus a non-resident, but for a natural person. Okay, natural meaning human being. So if you had to travel the world and take photos, and then you had to return always to South Africa, irrespective of how much time you've spent outside or inside the country, because you believe that South Africa is your home, you would basically meet the definition of this as being a ordinarily resident of the country, meaning that wherever you go, you always consider this place your home, and you would return from your wanderings. The other scenario is, let's assume that you're a non-resident. Alright, you're a non-resident, but as a non-resident, you have been placed in South Africa for a period of more than 6 months. Let's say you've been here for a full year, 12 months. That's greater than 183 days. So the chances are that you are probably going to have to pay tax as per a resident, not a non-resident. And that's what the government does in terms of classifying between resident and non-resident. If you've been in this country for more than 6 months, 12 months, let's say, you don't have a choice. Because you've been in this country for so long, you have no choice, but you have to pay tax according to a resident, meaning you have to pay according to your worldwide income. Previously, we did see something called a DTA, okay, a double tax agreement. Those things do also apply here, because remember, SARS wants to be as fair as possible. So if you are being taxed in other countries, they tend to not tax you twice on the same form of income. Right, and that's quite a nice thing to consider, because as much as they collect taxes from everyone in the country, they do so as fairly as possible. Right, and that's very important for us, because we know that taxes should be everybody's burden, not only the burden of a few. Okay, it should be everybody's burden. Obviously, the more you earn, the more you should pay, because that's what system we have currently in terms of being a progressive tax system for individuals. But if we're looking at companies, it's generally a flat rate of tax. Right, this is actually more important. So earlier you were telling me about, or you typed a note about domicile. Okay, so domicile, like for example, if you talk about a company, where is it domiciled, it would be looking at like where is the place's, inverted commas, home. So what SARS does in terms of its practice notes, they talk about this, place of effective management. So what does that mean? Well, effective management is quite a broad term to try to define very concisely. So what they've tried to do, SARS has tried to create certain definitions, i.e. based on the practice notes and the legislation, in order to help establish whether a company is domiciled, i.e. are they considered a resident or aren't they, depending on the criteria. So what I've underlined here and here are some keywords that you would look at that support what? This whole idea of effective management. Right, so the definition is very specific. Right, and remember, you can't dispute this. Last week and the week before, we looked at more the background regarding how you could go about maybe disagreeing with the assessment. Right, you know that the tax year is obviously 12 months, and you know that there are certain avenues that you could make use of to try remedy the situation if you're unhappy with what they've assessed you on. Right, so let's assume as an individual, you pay your taxes, you declare your income, and then you get a bill and you don't fully agree with it. Is it possible to query it? Definitely. And then it will go to maybe an arbitrator. You might settle out of court. It might even go further to high courts, and maybe even eventually to something like the constitutional court if you disagree with the rule of law of the country. Right, generally things don't go that far. Right, what do we normally do is we apply what the practice notes tell us. So if we're looking at a place of effective management, what's underlined is key. The place where the company is managed on a regular or day-to-day basis by directors or senior managers of the company, irrespective of where the overriding control is exercised. Right, so that's looking at where directors meet. So you could look at a board of directors meeting in a specific country, and they might have operations there. Right, if that's considered the place where they meet day to day, okay, regularly, right, chances are you're probably going to be considered a resident. So if the company, so for example, let's say an international company is operating in South Africa, and all their meetings take place in South Africa, and there are regular meetings where the big board of directors meet often on a day-to-day basis, and they make decisions on behalf of the company. Chances are you're probably going to be considered a resident, and you'll be taxed as a resident. You won't be taxed as a non-resident. And that creates a whole another consideration in terms of the amount that's due, okay, the amount that's payable. Something else they look at is day-to-day operational management. Right, so where are the managers sitting? Where are the line, how can I put it? The direct managers, so the line management. And then they also talk about business operations and activities are conducted or carried out. So where are those business operations or activities carried out? Are they carried out in this country or a different country? If it's carried out in this country, you're probably going to be considered a resident, and you'd be paying tax according to a resident-based system. And then the last thing is looking at the place with the strongest nexus. Okay, economic nexus. Right, economic nexus is just looking at where do you derive the most financial benefit. So this is just guidelines. Remember, SARS will apply these guidelines, and they'll either say yes, you're a resident, or no, you're a non-resident. You can always disagree, okay, and appeal or dispute what they've said. Right, so depending on your company in terms of operations, you may or may not want to dispute that, and it always comes down to, again, somebody's judgment. Okay, someone's going to judge, be it the arbitrator that's going to help resolve the situation, be it the judge, be it someone more senior that has the knowledge and experience to implement the rule of law as best as possible. Right, this you've seen before. Do you remember this calculation? You should. Right, most important here is what are we focusing on? So tonight, we're looking at this. The income. Later on, we'll look at deductions and allowances. Okay, that's a separate chapter. Later on, we'll look at capital gains. Again, it's a separate chapter. Right, so don't overthink tax. Right, tax is actually a very simple subject to do well in, as long as you can categorize what you're looking at. So, for example, anything that I look at tonight is going to be focusing on this first line. Income. And what goes into that. Okay, remember income would be like gross income, the income that you derive, the total income. And then with the total income, you then have other forms of income that we would probably consider adding at a later stage. Right, so that's what we're going to be focusing on. You've seen this template before. It's not new. It was covered in chapter 1 right at the beginning. We're just going to be expanding on the rules for each of the different lines. Right, and that's why I've tried to give you this. So when you look at the other notes, you'll see I highlight different lines. The only reason why I do that is because it's focus. Okay, you're focusing on a specific line. Every line has a specific set of rules that you need to follow. So I don't know how well you deal with rules. Okay, some people love rules. They love being told what to do. Okay, how to do it. Some people like being given more creativity, okay, more freedom to approach it themselves, okay, without having to follow something very specific. It all depends. Some people like a mix of the two. So again, it depends on you. Okay, what we do have to do here is we need to follow the rules in line with what the legislation says. Right, so whatever SARS says in terms of their rules, we need to implement and we need to apply. First one, residents are taxed on all of their worldwide income. There's the key word, worldwide income. So it doesn't matter where you are. It doesn't matter where you're conducting business. Should you consider yourself being a resident, if you consider this as your home, as a company, if you're operating from this particular city or town in this country, chances are you're probably going to be considered a resident. Right? You might be considered a non-resident depending on how long you've possibly been in the country for, depending. Right? So it can be quite subjective at times, but not always. You'll see here the rules are pretty straightforward. They do look at specific things. Just a quick question here about deemed. Have you heard this word before? If you have, what does it mean? If something is deemed to be something, what does that mean? What is that referring to? Something to consider. Deemed, said to be, yes, definitely, good. That nice way of explaining it. Or if I just look at something like a synonym for it, I could look at something like. Okay, so if something is deemed to be, I could say something is like something else. Okay, or similar to, or something along those lines. Right, but when we look at tax, they tend to use that fancy terminology and they talk about deemed income. Okay, a deemed disposal. Right, so if I sell an asset, I've deemed to have sold the asset. Or if I've bought goods, to use goods, or to sell goods, there could be deemed income that would be included in the calculation. Right, most important thing to consider here is the source. Always, 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 always consider the source. The source means where is the income derived from. Right, and the textbook does the study guide does quite a good job at giving you different examples. Right, so scenarios where you have an example whereby people are introduced, okay, and those individuals then learn more about a specific business perhaps, and in terms of income, they'll be looking at different forms of income. So different businesses have different forms of income. It's always the case. Remember, the main forms of income would be sales and services rendered, but there could be other forms of income. And if there are, something as simple as rent income. Rent income is income. Right, rent income comes from leasing property, right, to tenants and collecting the rent. So the source is always important. And that's why from an application point of view, you need to always consider, well, what was the cause? What created that income? And then the second thing is, well, where is the location of the cause? Meaning, if someone created that income, where were they based? Like, what was the like the place, the main area, or the business? Okay, where is the business situated, etc. And that's dealing more in terms of like your cause. Okay, cause and effect. Cause meaning something that exists today that was based on something else from a previous person or individual. Okay, it's almost like growth. Okay, people move through like let's talk about something as simple as working for an employer, as an employee. As an employee, you're probably going to be looking at the next step, i.e. the next promotion. And then after that, you'll look at the next promotion. And after that, you'll look at the next promotion. And then at some point in time, you're probably looking at the highest promotion, which is CEO. Okay, running a big company. When looking at source of income, we're not looking at the top in terms of like the spillover effect. We're looking at the core. So where did it stem from? Like, what actually created that income? Was it an individual? Was it a business? Like, what was the catalyst? Okay, what was the cause? What gave rise to that income? And if we know what the cause is, then we'll know how to treat it in terms of tax, and we'll know how to declare it in terms of income. Okay, I've just given you a few steps. This comes from the actual study guide, and also a little bit of a consideration in terms of legislation. I've tried to explain here what this whole idea of gross income is. Okay, you've probably seen the word gross income before, or maybe gross profit before. Right, gross profit we know is sales minus cost of sales. Right, gross income is very different to gross profit. So just be careful with that. Gross just means total. Right, so everything. Right, and remember we spoke about an accrual principle. Does SARS care whether you've received the money or not? Not really. They just want to know, well, any person who's a resident, okay, who derived income worldwide, okay, worldwide because we're dealing with the resident. It can be cash or otherwise. Cash meaning physical money that you received, or otherwise. Otherwise could be something like a credit sale. Right, you've sold something on credit. There's no exchange of cash, but there's still a sale. Received by or accrued to in favor of that person. That's the definition. Right, that determines what an asset is. And that's the key. If you understand what an asset is, you can then take advantage of those types of things. Okay, because you're either going to want to be classified as a resident or a non-resident, depending on the situation. The next bullet says, any person who is a non-resident. Non-resident, we've spoken about that in terms of the physical presence test, so someone who hasn't stayed in the country for a very long period of time, or somebody who considers somewhere else their home, and they're just visiting the country, okay, maybe to do business, or to go on holiday, or whatever the case might be. Right, so for non-residents, people that don't believe that South Africa is their home, in terms of returning to after their wanderings, and if they don't believe that, and let's say they're going to go back to their home country, right? Let's just say the US, right? So they come to South Africa, they have a nice holiday, and then the individual, i.e., a US citizen, decides to go back, right? And they haven't spent much time here. Chances are they're probably going to be considered a non-resident. And we spoke about this earlier. Non-residents are only taxed according to their source within South Africa. That's key. Right, so any business that's conducted that's within South Africa would be considered from a South African source. Right, again, the taxes are quite involved. We can always discuss that maybe at a later stage. Right now, it's just theory relating to how does a business make use of these beneficial classifications in order to try reduce the amount of tax that you're going to have to pay. Always during the year of assessment, that's very important. Right, so in other words, the last 12 months in terms of tax year. Right, so that's step 1. Step 2, determine income as defined in section 1. Right, very important. I doubt you're going to have to quote specific acts and lines from the actual Income Tax Act. You weren't required to purchase that legislation. All right, in later years, if you do decide to do more tax, it does become more challenging because now you need to know more detail regarding how to treat certain, what's the right word? Certain products or certain services, example. Okay, always remember to keep it simple. Just determine what income is. After you've got income, then you need to look at what's taxable, what isn't taxable. And that gets done at that particular level. Okay, so I've given you a bit of a summary here that comes from the study guide. Okay, we're looking at definition of income. That's the key. So how does the income define income? Well, it's quite specific. They talk about this whole concept of gross income. Remember, gross income is before we have other things like deductions and other allowances. Gross means the total, the everything. So what SARS does in terms of the rule, they define it as being, in terms of requirements, the total amount in cash or otherwise received by, accrued to, or in favor of a person during the year of assessment, excluding amounts of a capital nature. That's very important because that's taxable capital gain. Okay, CGT. We'll be looking at taxable capital gains in a later chapter. Right now, all I'm interested in is gross income, i.e., what forms part of this line. Okay, the one that I highlighted here. That's what I'm trying to answer. Okay, what do I put there in terms of income? Do we need to meet all the definitions? Yes, we do. Okay, you have to satisfy all the definitions because you have to be classified as being part of the inverted commas like club, if you will. All right, so in order to make use of a specific let's say product or service at a specific store, you may or may not have to register for a card for that club to make purchases from them. Okay, and that's pretty much what this is dealing with in terms of recognition. Right? How do I recognize what income is? How do I know if income is actually income? And the key lies in knowing this definition. Right? And I've seen theory questions come up, so please don't overlook this. This is very important. Make sure you know the definition. Make sure you know what all the criteria is, right? Because you could be given like a 15-mark question where you might be given a scenario and then you're going to have to then comment and discuss this whole idea of a income, a receipt, an accrual, that type of thing. Right, so just to keep it short, if I'm looking at income, we need to meet all 5 definitions. You have to. All 5 need to be met for something to be classified income. If it's not all met, then it could be considered exempt income, which will be specifically removed, or it could be seen as a special inclusion, meaning not meeting those 5 points, but we're still going to include it. Right? That's something to consider. What is the difference between exempt and special inclusions? Well, exempt meaning you're not going to pay any tax on it. Right? Special inclusions meaning something that was possibly considered being exempt, okay, possibly having to pay taxes depending on. Try carry on and let's see how interactive we can try and make the class. Yeah, the connection seems a little bit better now that I've called you back. Okay, so subjective and objective tests. If something is subjective, what does that mean? Yes. Okay, good. So the word bias is important. So subjective means there's like room for interpretation. Objective means it's factual. Okay, you're complying with the rule of law, the letter of law, and that's case law. So case law is very objective. Okay, the law is the law. We need to apply it. And that assists us in determining income. Interpretation is everything. That's the key, because income might be something as simple as sales, and sometimes it could be more complicated than that. So as an individual, you always need to declare your income. Right, what I've tried to do here is I've tried to pull out all the cases that I've seen in the textbook over the two books in terms of like income definitions that relate to this particular area. Very important though, just because cases are talked about. Remember, you're not studying law, but we still need to know cases, because cases help you with motivating whether something is income or whether something isn't. Okay, because that's the big debate. And remember, you as an individual, do you want your income to be classified as income, or would you prefer your income being classified as capital? If you had a choice.
I think you'd rather have it classified as income, so.
No, actually, you'd rather want your income to be possibly classified as capital, because capital is taxed not according to income tax, but is taxed according to capital gains. Okay, and that's something to consider.
Yes.
Yeah, so later on you'll see capital gains is actually a better form of tax. So if you had to pay taxes, you'd probably want to pay taxes according to CGT, and you wouldn't really want to pay tax according to income tax. Because remember last week we saw income tax for an individual. What's the highest rate? Highest marginal income tax rate for an individual is how much?
45%?
Exactly, 45%. And that's a lot compared to CGT, which could be a lot lower, because only a portion of the gain, not all of it, is going to be taxed. Okay, it's almost like looking at the gain on the investment, so the profit that you make if you're buying and selling an asset, versus, well, if you bought and sold something in terms of retail, how much revenue did you generate? What was the bottom line? That sort of thing. Okay, so just bear that in mind when looking at questions that relate to this in terms of theory. Just remember that there are certain cases that are more important than others. In terms of past papers, I do see from time to time they do give quite long questions, like a 10 mark, 12 mark or 15 mark question, whereby you're going to have to explain theory in quite a lot of detail. And that's why I've tried to put this on the board here in terms of giving you some background information regarding what cases could possibly be asked. And then in brackets, I've put a little bit there in terms of what does it relate to. So for example, CIR. CIR is looking at the Commissioner for Inland Revenue. Okay, that was the old name for SARS. Obviously we know SARS as SARS, African Revenue Services. Prior, there was a different name for it, okay, CIR, and that's why when you look at older case law, you still see CIR based in those like documents. Right, it's just how it works. Remember we spoke about law of precedent, past affecting the future?
Yes, sir. Yes, sir.
That's exactly why you need to learn these cases. Okay, the ones that are more important, the Halden Hayes case, look at own benefit. The Pep Store case, look at entitlement, when something accrues to someone else. Butcher Bros, ascertaining the amount, okay, cash or otherwise. So you might say, well, I didn't receive the cash, okay, I didn't get physical cash from my customer, but the customer bought on credit. You had a credit sale. Would you think would a credit sale be part of your income? What do you think?
I think so. So the thing must be as and when they happen. So
exactly. So you're trying to use the definition as and when it happens, 100%. Right. If you're looking at a credit sale, there's no exchange of cash, and that exchange of cash could happen maybe 3 months, 4 months, 5 months down the line, depending on when the consumer is actually going to have to pay for those items that they had purchased. Right, so having said that, just be careful in terms of looking at they call it, I think the right way of describing it is substance over form. Okay, what are you actually doing? Are you buying and selling goods from this country? And if so, great, then that could be seen as a form of income. And then are you doing other things that are more passive, perhaps, that derive other forms of benefit? And that'll be seen more as maybe maybe factual, more objective. So certain things you have to just do because it is what it is, and so other things can be debated on. Right, and that's kind of where we are in terms of like consulting the legislation. Right, so the legislation says one thing, SARS says another thing, but when we put both of those things together, it should sort of harmonize and keep the system going and keep the revenue coming in terms of revenue for the business. Okay, remember, the business is not the business would be the country. Right, so obviously the country is going to want to bring in as much revenue as possible, and they would want to then use case law perhaps in their favor, perhaps that can help them collect more from their employees. Okay, or not employees in general, but from their citizens perhaps. Okay, let's look at the next bit. Okay, this is a very, 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 very popular case. Right, courts use subjective and objective tests. Why? What are we trying to test? We're trying to test this, income. So how do you know if income is income? Well, earlier you saw those definitions. Do you still remember what they are? There were 5 criteria.
The ones for what is it called? The ones that were all supposed to be the ones where all the requirements need to be met.
Yes, yeah. So that's what I'm looking at. So that criteria is objective, meaning if you meet that criteria, you'll meet that criteria. Okay, here is looking at more advanced tax application. Okay, when I say more advanced, we're looking at case law. Right, so if we consider the example here, CIR, the Commissioner for Inland Revenue versus the FISA case. Okay, let's discuss it. I've put a note here as tree and fruit principle. So what they describe here is something that looks like this, a tree.
Yes, sir.
Okay, where you have fruit and then you have the tree. So if I'm selling the apples, is that going to be viewed as income or capital?
I think it would be seen as income.
Exactly. Because that's this whole idea of a tree and fruit principle, right? Where you have a business that's deriving income. And that income would be viewed as income if it is derived from a source, right? The source would be the business. If I had to sell the tree, would that be seen as capital income?
Yeah, it's because it would be like you selling your business as a whole.
Exactly, yeah. That would be like you selling the business, exactly, or the machinery. Okay, so you get different forms of income. Okay, income is income, so long as it's received or accrued to by an individual during the year of assessment, etc., etc. That is the whole definition. Right, most important bit that I've given you here, though, is just this whole idea of the tree and the fruit principle. So, if I'm looking at the tree, it's generally going to be seen as capital in nature. Right, if it's going to be the fruit, it's generally going to be seen as income in nature. And that's kind of how they apply the legislation, looking at this tree and fruit principle. So, for example, property can be considered a tree, or it could be considered the fruit. If you're an estate agent and you're selling property, well, then it's income. You're selling property. But let's say you're the home owner and you live in the property and now you decide to sell your home. Right, would that be considered income? No, because it is only one transaction. It's not your core business. And you're probably living in that environment as well. Does that make sense?
Yes, sir.
Okay. These are subjective and these are objective tests. Subjective meaning there's an element of, inverted commas, interpretation or opinion.
Yes, sir.
Right, opinion is looking at things like this, nature of the receipts. Okay, so nature of receipts meaning, well, how did you receive what you received? Okay, and in terms of sale of the assets, right, if I'm selling assets, do you think that's going to be seen as income?
No, sir. I imagine that would be capital.
Well, the big question is, what assets are you selling? Do you agree? Because what happens if I sell stock? If I'm selling stock, do you think that's income? Hey, Unam, if I'm selling stock, do you think that's income? Unam?
It's going back to.
Yes, okay, it would be seen as income. Do you agree? Okay, so if I'm selling an asset in terms of stock, income would be what I'm selling in terms of stock, trading stock. But if I'm selling machinery, Okay, would that be seen as a sale of asset? Yes, it would. But see, it's subjective because it comes down to your intention. Okay, am I selling the machine because the machine is old and I want to buy a new one? If that's the case, then it's probably going to be seen as capital. And another thing to consider is continuity and change of intention. Right, and those are subjective tests, because subjective meaning there's room for interpretation. So in 1 year you might believe, well, let's say you sold some of your cameras. Okay, you're obviously not in the business of selling cameras, but let's say you do. Right, if you sell a camera, it's probably going to be seen as capital, because you could debate, well, in terms of intention, was your intention to sell cameras? Probably not. In terms of continuity, okay, are you going to continue to sell cameras? Probably not. It was probably a once-off thing. Right, and that's why you need to consider these subjective tests in terms of opinion. And then once you've got that opinion, you're then going to apply something that's more objective. Right, manner of acquisition, the period, the manner of the disposals, how did you sell it? Right, if I'm selling it for cash in a retail store, it's probably going to be seen as income. Okay, if I'm selling it to a business owner and it's a one transaction type thing, going through a different channel perhaps, then that could be seen more as capital. Okay, where I actually maybe sell the business or sell the equipment. Okay, it could be something different in terms of how you've bought or sold it. The nature of the disposal, reason for the receipt, legal nature of the transaction, etc., etc. That's just a list of subjective and objective tests. Right, do you need to know this? Definitely. I've seen a lot of past paper questions where they literally test the detail and it's actually applied to a scenario. Right, so you'll see some in the textbook just now. We'll look at some examples where they give you a scenario and then they talk to you about, well, discuss, explain if this is income or explain if this is capital, that sort of thing. That's the application that you'll have. Just a question about burden of proof. What does burden of proof deal with? And who has the burden of proof?
So can you hear me, sir?
Yes, I can.
Oh, okay. I think burden of proof talks about who is supposed to basically, I'd say, almost prove that the income there is, or rather, the details on the tax form,
yes,
tax sheet. This is actually what I'm supposed to be paying.
Okay, good. So do you agree it's providing evidence?
And I believe that can you hear me, sir?
Yes. Can hear you. Not so well, but I could hear you. I know you're talking about burden of proof and whose responsibility.
Yes, sir. I'll just keep switching between
yes,
the microphone and writing, just to make sure.
Yeah, perfect. That's not a problem. Yeah. If you do that, then at least I'll be able to see it. That's perfect. Yeah. Okay, but yeah, you're right. So it's definitely got to do with what? The objective. Do you agree?
Yes, sir. Yes, sir.
Okay, it's that intention, it's that objective, it's that objectiveness or objectivity in a way. So you're always going to have to, number one, identify someone's opinion, okay, and then number two, you need to prove by using facts. All right, so generally, subjective and objective tests are going to be applied, and that's the burden of proof in terms of the evidence that you are going to have to give to prove what you're trying to prove. In other words, so for example, let's assume that you've sold a camera, okay, and that camera that you've sold, you believe that it's capital in nature, meaning you shouldn't pay tax according to income tax, you should be paying tax according to CGT. Right, SARS could argue that, well, no, you're a photographer, so all photographers sell cameras. That's what they could maybe assume in terms of their opinion, perhaps. And they could then maybe say, well, all right, if you are going to be selling cameras, you're going to be viewing that as income. And they might say, well, Unam, you are going to have to classify that sale in terms of the camera as income and then pay your income tax on it, rather than treating it as CGT. That could be a consideration. So, having said that, if SARS believes that should be income, and they disagree with what you say, right, the burden of proof would be on the person that's basically making that accusation. Right, so if you believe that it should be treated as something different, and SARS hasn't treated it that way, and then it's your burden of proof. So you're the one wanting to try prove or try state that that's what the case is, basically. Right, so it all depends. There's no like one shoe fits all type of question or scenario. It all comes down to motivation. It comes down to, can you apply the subjective test? Can you apply the objective test? And as I said, this is a very important topic when it comes to theory questions that I've seen in the past. And it's like 5, maybe 6, 7 marks, depending on how much motivation they want you to provide. But definitely something that I've seen in terms of focus, okay, the way they test it. Right, the next thing, I've just tried to put some special inclusions. So this is all covered in your study guide as well as your textbook. They talk about specific things that you have to add, i.e. you've got to include, and things that you can exempt or remove. Okay, very important that you know the difference. So the first thing is lease premiums. What is a lease premium? What does it relate to? Any idea?
Well, can you hear me?
Yes.
Just to make sure. Okay, a lease premium, it's basically the extra bit that you have to pay on a lease that you might have taken out above, right, and yes, above the normal, I suppose, the normal rate that you would have paid.
Yeah, well, premium just means a regular amount, an amount that's being paid on property. Yeah, so lease premium would relate to that consideration. Okay, leasehold improvements also similar to that in terms of relating to property that's being bought and rented out. Then you've got proceeds from a disposal, very, very specific, that's included. Okay, notice added to taxable income. Taxable income is what we're going to be paying tax on. Okay, we don't pay tax on gross income. We pay tax on taxable income. So must we include these as part of that? The answer is yes. Right, so these are things that don't meet the definition of income, but must still be specifically included. Does that make sense?
Yes. Awesome. Yes, sir. Can I ask a question in terms of special inclusions? Yes. Number one, I realized when I was reading leasehold improvements, it said there, let me just get
Is this from the study guide?
Yes, from the study guide.
Okay, we'll go there just now, or let me go there now then. Yeah. Okay, so the study guide, that was the intro. They spoke about the format. They talked about taxable income as being the main focus. Then they've given you some prescribed textbook pages to read. Background we've looked at. We spoke about gross income. We spoke about the definition in terms of residents versus non-residents. And we looked at the definition. See, there's the requirements. Do all the requirements have to be met? The answer is yes. You don't have a choice. Okay, all the requirements have to be met in order for this to be classified as income. Does that make sense?
Yes, sir.
Okay. Then they talk about the definition. Then they talk about specific inclusions. There we go. Right, they talk about the law of precedent, which is things that we've been looking at so far. There's that commissioner for Inland Revenue and Butcher Bros. Okay, this was one of the cases that they are looking at in terms of determining an amount. It's not always straightforward. Right, so how much is the amount? What are we going to view as the actual income amount? Is it going to be the rand amount? Is it going to be the sales amount? What is the amount that we're going to use? That's what we're looking at there. There's Clayton Hayes. There's CR versus People Stores. They talk about what that focuses on. The one is looking at received by the taxpayer, and the other one is looking at this whole idea of accrued to. Okay, remember the definition is very specific. They talk about accrued to or received by. Either or will be taxable. Year of assessment, we've discussed that before, 12 months. Excluding amounts of capital nature, see, let's look at the tree and fruit principle. Tree and fruit principle is looking at the FISA case. Then they talk about the subjective and objective tests. This is what I've given you in the notes. And then we're looking for leasehold. There's one question, one application. Okay, nice case study. Talks about growing herbs for a farmer, and then will they have to be, or would they be classified as being a capital in terms of nature or revenue in terms of nature, and then they describe that. You have to go through all the definitions. I'm actually going to go through probably the examples with you next time when we do the next assignment, because the next assignment is probably going to have longer questions where we'll have to look at the actual theory and how to apply it. I'm just trying to find your leasehold stuff. Okay, here's the special inclusions. Here's it. Leasehold. Okay, so what did you want to say about this? Leasehold improvements. Unam, what did you want to say about this? What is your question? Can you hear me? Ooh, no audio. Unam, you're going to have to write. You're going to have to type it in. Nothing's coming through. Yeah, you're going to have to type, unfortunately. Sorry, I can't hear anything. What is your question about leasehold? If the actual amount is less, does the same apply? Is that it? Or is there another part?
Yes, so that was all.
Oh, is that it? Okay, so if you look at what they've given you here, okay, let's read it. It says, a lease agreement may specify that the lessee is obliged to erect or effect improvements on the leased land or the leased buildings. Okay, so you have to create something. Okay, you've got to build something. This means that the person who is renting the property will incur costs to improve or extend the property. Right, so what does that mean? Well, do you agree? The person that's renting the property, they're the ones actually trying to improve the property. But remember, the property is not for the benefit of the tenant. The property is for the benefit of the owner, which is quite ironic because the tenant is the one actually paying for it, which is quite interesting. So that's what like this leasehold improvement thing is focusing on. Right, then they go on and they say, the value of the improvements effected to the property must be included in the gross income of the lessor. Right, the lessor is the person leasing out the asset. So the value of the improvements, because think about this. So let's imagine this, Unam. You're the one owning the building. Okay, you own the property. I'm your tenant. I am leasing a property from you. But now I am going to choose to improve the property that you've given me. So I'm going to install some fancy machine, and that's going to increase the value of the property. Okay, what are you as the lessor going to have to do? You as the lessor are going to have to include that improvement as part of your income, because it was an indirect type benefit that you receive. That's a special inclusion. Whether you like it or not, it's going to be seen as a form of income. Okay, it's treated as a special inclusion. Is that alright? Okay, in terms of the value part,
yes.
They say the value to be included is the amount stipulated in the lease agreement as the value to be expended on the lease improvements. If the actual value of the improvements, example, 700,000, is more than the amount stipulated in the agreement, 550, then the amount to be included in gross income remains the amount in the agreement, 550. Right, so do you agree you can't include more than what you've agreed on? Right, so if you've agreed on 550, but then you actually improve and your improvements are 700, okay, what are you going to have to include in your gross income? The amount that was included as part of the agreement, right? Because the agreement would have been set out as per the contract. Right, so the lessee is able to claim a deduction for the leasehold improvements over the period of the lease. This will be dealt with in Tax 3701. Okay, you don't look at leasehold in detail here. All you're going to be looking at here is, well, is this income or isn't this income? And the answer to that question is, it is income. It is income to who? The lessor. The lessor is the person who owns the property who's renting it out. That individual is going to have to include something in terms of monetary value as part of the leasehold improvements, which will be a special inclusion. Does that make sense?
Yes, sir.
Okay, perfect. Wrong one. This one. Okay. So this is something that we'll see as we go through more examples. Okay, I'm going to take you through some just now. Just the last bit that I wanted to highlight here is the exemptions. Exemption means I can remove that from my income, my taxable income. So do you want exemptions? Of course you do. They help reduce your taxable income. And if you reduce your taxable income, you end up paying less taxes. Does that make sense?
Yes, sir.
Okay, and what can be what will form part of the exemptions? Well, something like dividends, something like interest, something like government grants, that could all form part of the exemptions. Things that you would specifically include, but then also specifically exclude in the form of an exemption. Alright, so now we need to go back to the study guide and we need to practice. Okay, so I'm glad you asked me a question about the study guide because at least we've covered some of it. I want to go up to the top here quickly and just walk you through this example. Okay, where is it? Here's it. Gross income. This one here. Okay, the case study. Have a look at this. You've got Mint Limited. Okay, has been carrying on the business, growing herbs for many years on the land it owns. This is the only business of the company. During the 2008 year of assessment, Mint bought an additional farm from a deceased estate at a favorable price. At the time, the company did not need the additional land, but it decided to hold it until it was required for planting herbs at a later stage. Because of the economic recession, the company decided that it no longer required the land for future use and sold the farm in February 2008. The land as land suitable for livestock farming. Right, so do you remember the definitions in terms of what is considered gross income? Look at your notes. Tell me what the first definition is.
The first definition is the total amount. I wonder if you can hear me.
Yes, total amount. So if
Yes,
I'm looking
sir.
at the total amount, is there any amount here? No. But I'm going to be looking at, well, was this received or was this accrued to? Does that make sense?
Yes, sir.
Okay, so the question in terms of required says, am I going to be viewing the farm as capital or as revenue or income? Ideally, you'd want it to be classified as which one?
I'd say capital.
Exactly, because if it's capital, you'll end up paying less taxes. Right, so the big discussion here is question mark. You need to look at subjective and objective tests. Right, so
Yes.
the solution is very good. They talk about the manner of acquisition. Okay, how did you buy it? And they also talked about intention. So was your intention to sell the property? No, your intention was to use it for farming. Do you agree?
Yes, sir.
Okay. And then they talked about a change of intention. So initially you wanted to use it as a farm. And then later on you changed the intention because now you're going to sell it as land. Okay. Then they looked at period in terms of the asset which was held. Right? It was held for almost 8 years. That's a very, 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 very long time. Do you agree?
Yes, sir.
Okay, and then if we look at the nature of the asset disposed of, well, it's a farm. Does this farm allow you to produce future benefits? Or what can you use the farm for? Well, do you remember in the case study we read there, it can be used for animals. Do you agree?
Yes, sir.
So if it's used for animals, that whole tree and fruit principle could apply. So do you have the tree here or the fruit?
Yes.
Which one, tree or fruit?
Right.
The tree, 100%. Right, the tree is the important bit. Why? Because the tree is the actual producer of income. Right, and that's why they debated that. And then when you have something like this, I would even talk about the FISA case. Okay, when you see, when we do past papers, I'll actually show you that if you can, try to remember what those cases are, and then try and include them in your discussion if possible. more often than not, it impresses the actual examiner or the marker. Right, so if you can remember some of those cases, try your best to use them when explaining the theory. Because if you do that, you're probably going to get marks for mentioning the cases, as long as those cases are applicable to the debate that you're having in terms of theory. Does that make sense?
Yes, sir.
Okay, perfect. Alright, then we can carry on here. Okay, let's discuss this one. This was quite a quick one. Gross income. Bank A receives a deposit of 1,000 on 1st of March. This money is deposited into a savings account at the bank as an investment. Okay, do you think the bank's going to view that as income? Definitely not. Why? It's considered a deposit. It's someone else's money. Do you agree?
Yes, sir.
Okay, 6 months later, Trading Limited withdraws the amount and the bank pays the company an amount of 1,050, comprising 1,000 original capital invested in 50 Rand interest. Determine, giving reasons, whether the amount of 1,000 received by Bank A will be gross income. Obviously not. The amount of 1,050 received by Trading Limited as gross income, it would be, because the 50 would be seen as income, a form of income. Do you agree?
Yes, sir.
Right, and it will have to be included. Right, so the solution, the receipt of 1,000 by Bank A, they talk about the principle, the application, and the conclusion. Not received by. Okay, remember, is the bank entitled to that 1,000? Yes or no?
Yes, sir.
No, they're not. They're not entitled to it. Who's entitled to the 1,000 deposit? The customer.
Yes, sir. Yes.
So, is it going to be gross income for the bank? No, it's not. Because the bank was never entitled to it. Does that make sense?
Yes, sir.
Okay.
Yeah.
In terms of receipt of the 1,050 from Trading Limited, that's what they received. Would that be capital? Definitely. In terms of the tree and the fruit, do you agree the tree was the 1,000, the fruit was the 50? Does that make sense?
Yes, sir.
The interest is the income. Make sense?
Yes, sir.
There we go. That's what they describe here. The tree and the fruit principle. Okay, then the textbook talks about gross income in terms of special inclusions. We've looked at this. Lease premiums we spoke about. That was the lease premium that is the amount that the lessee pays the lessor. Okay, it's like a rent. It's like a rent agreement. Okay, it's a lease. A lease is a form of rental agreement. Leasehold, we read that, so we covered that in detail. That's fine. Proceeds from the sale, not sale. Well, yeah, kind of, because it's disposal. Obviously, you would have to have sold something in order to receive proceeds from it. Okay, so proceeds from the disposal of certain assets. If a taxpayer sells an asset that was manufactured, produced, constructed, or assembled by him, the full proceeds are going to be classified as gross income. Again, it's looking at what? Tree and the fruit principle. That's the best tip I can give you. If you can look at everything as tree and fruit. Tree, capital. Fruit, income. Keep it simple. If it's the benefit or the derivation of income from something that's providing it, that's going to be viewed as income. Okay, so interest that I get on savings, income. Dividends that I get on shares, income. Right, anything that comes from it, even rent income, renting out a property, income. Okay, makes sense?
Yes, sir.
Great. Dividends. Can dividends be received or paid? It can be both. Do you agree? So
yes,
would you include dividends? Yes, you would. But then, can you exempt dividends? Yes, you can. Right, so from a test point of view, do you agree dividends are exempt? So that means the net effect is actually zero. Are you just going to leave it blank then?
No, sir.
Of course not. Because the examiner's not going to know if you forgot or you just didn't put it in. Does that make sense?
Yes, sir.
So be careful. When you are writing your tests and exams, you need to make sure that you specify what this is. Even if you know it's not going to be included. Right, you still write down gross income and you write down what it is, i.e. dividend. And then you can say, well, the dividend, part of it was paid out, part of it wasn't, depending on what the scenario is. But you can just say, well, if this is a dividend, what is it? Is it going to be income or is it going to be capital? Alright, chances are it's probably going to be seen as income. But then depending on whether this is exempt or not, that can help you as well. So we know a dividend is a form of income, it must be included. But now dividends from certain companies, okay, South African companies in general. If I have dividends from South African companies, all those dividends are shown as income, and then all of those dividends from South African companies would be then claimed as a exemption, okay, exempt income. Does that make sense?
Yes, sir.
Perfect. Okay, and then they talk about key man insurance policies which the employer can take out on certain individuals like directors. Recoupments we'll see later in more detail. We'll look at CGT.
Yes, sir. Sorry to take you back, sir.
Yeah, is key man insurance, is this in cases of death or resignation also included? Okay, key man insurance isn't looking at the resignation, it's looking more at the death. So you would have a key man insurance policy on a director, for example, because the director is very, very, very important to the business. Okay.
Yes, sir.
It is very specific. We would have to look at the legislation in terms of Section 11W of the Income Tax Act, which is not covered in this module. Right, you would look at that in detail in TAX2601. Okay, all we need to remember is, if the company is taking out the insurance policy, okay, and the company is going to receive the proceeds, must the company classify this as a form of income? Yes, they must. That's the key.
Yes, sir.
Okay, so whether this was for a director or a CEO or whoever, as long as there are key man insurance policies, if they pay out, it'll always be considered as a special inclusion. And you'd have to pay tax on it as a company. Got that?
Yes, sir.
Okay.
Yes, sir.
Recoupments we'll look at later on. You'll see what that means when we cover the right chapter. Right now, you won't have much of an idea of what that is, unless you've read ahead. Exempt income, we spoke about that in the notes. You have two: dividends, interest, and you can get other things like government grants. Right, that was something else that was mentioned here. Some types of taxpayers are exempt from tax include. Okay, so these are persons that don't need to pay tax because they have an exemption. Right, exemption meaning they don't have to actually pay taxes because they're either part of government or they're special. Okay, such as an institution, board or body which as its principal objective conducts scientific or technical research, or a body corporate in terms of sectional title, a public benefit organization, retirement funds, etc. Okay, all of those are taxpayers that have exempt income. Exempt meaning, do they pay tax on it?
No, sir.
No, they don't. Okay, they show the income, but there's special rules that apply to those things. Alright, types of income that you saw in the notes. And that covers that chapter. Yeah, perfect. Okay, so I'm going to test you with one of these. Okay? Maybe look at the screen and you can use the example here. The required. Discuss what amount, if any, will Super Football should include in their gross income. Okay, so what does that do? In terms of exam technique, I would be highlighting this. Gross income. Right, then what do? I go to my notes. Okay, I should have left those notes open. Let me open them again. I close them. I'm going to go to income, which is over here. And I'm going to go down the list. Okay, so the first thing, total amount in cash or otherwise, received by or accrued to during the year of assessment, excluding amounts of capital nature. Okay, so let's go and let's have a look. Discuss any amount that will be included in gross income. All the amounts you need to discuss. So the first bit, sports football owns the sports football team. Sports football receives income in the form of gate sales and prize money. Okay, let's talk about gate sales and prize money. Recently, it sold two players, namely A and Star, Big A and Starball to Westville Limited. So now they sold to players. Okay, so this is a soccer club. They didn't just sell tickets; they also sold players. Big A was sold for 5 million. Big Star was sold for 25,000. Right, you can obviously see there's one very, very, very good player and someone that's not so great. Okay, so
Yes.
are the ticket sales going to be included in income? Yes or no?
Yes, sir.
Yes, it would.
Yes, sir.
Okay,
Yes,
it's
sir.
included because it was an amount received to or accrued by during the year of assessment. Okay, in cash received or not makes no difference. Alright, not of a capital nature, definitely not. Okay, these are gate sales, watching the game. Okay, in terms of prize money is an interesting one. Okay, because prize money is actually given as a reward, do you agree? As a prize. It could be seen as part of your operations though. So I would probably monitor, or not monitor, but manage that or declare it as a form of income as well. Right, the players. Do you think the players are a form of income? Yes or no? Is that the tree or the fruit?
I think it's. I think I was gonna say capital, so because you don't sell them all the time.
100%.
Yeah.
Good. Yeah, you're not in the business of buying and selling players every single month. Okay, it might happen maybe once a year. You might buy a new player, etc. Right, to make the stream stronger. Right, but it's not something that's going to be actively being done. Okay, in terms of month on month, week by week. Okay, there's generally a longer time frame associated with that. Okay, so really good, yeah. And then they talk about Big A. Big A started playing football 8 years ago under the 24 team. After signing a life service contract, was trained until he was the #1 striker in the country. Okay, that's additional information that can allow you to motivate those points in the actual description. Okay, remember, amount accrued to or received by, cash or otherwise, all of that. Star Ball snapped up at a bargain price for 3,000 when purchasing. The board of directors football realized he would not suit the style and play on the team. He anticipated being able to sell Super at a quick profit. This happened only 8 weeks after purchasing. Okay, do you agree? They're selling him at a quick profit. Okay.
Yes, sir.
They sold him over the short term, 8 weeks after purchasing him. Right. Was it their goal to buy him to sell him?
I don't think so.
No, it wasn't, because they said he didn't meet the suit of he didn't meet the style of play. So they bought him to try use him as a player. He just didn't fit in the team. So is this seen as income or capital? Definitely capital. It's tree and the fruit principle gain. You're dealing with the tree. Make sense?
Yes, sir.
Perfect. Okay. Do they have answers for this? I think they do, but we're going to have to look at it at the back of the textbook. Let's just go quickly and see where that is. Just to highlight and check what they've written there. 4.1. There's 4.1.
Page.
Okay, there's 4.1. See, look at the technique, Unam. Right, the textbook is brilliant. I can compliment UNISA here in terms of the approach. Okay, other institutions do the same thing as well. Right, they give theory, and then they explain theory, and then they give examples. If you can do those 3 steps, you're never going to go wrong with a subject like this. Right, so always give the definition. Always. Because the definition is going to carry marks. Have a look at this. 1, 2, 3, 4, 5, 6 marks just for knowing what the definition is. Easy, hey?
Yes, sir.
Okay, and then you need to apply the definition. So what I would have done is, next to each of these, I would have written a little description. Okay, UNISA has chosen to give you a paragraph describing what they have over here. That's perfect. Either way works, as long as you cover everything. Go through each point and discuss the merits for every point. Do you agree or don't you agree with that specific point? Does it make sense?
Yes. Yes, sir.
Great. Right, if you continue reading, you'll see they talk about the 2 players, Big A and Star Ball. Right, we're looking at them as being of capital nature. Right, in order to determine whether the amount was received to by taxpayer capital, one needs to determine whether the taxpayer's intention was with the acquisition and subsequent disposal. We know that wasn't why they bought those players. Do you agree? They bought them because they wanted to play for the club or the team.
Yes,
Makes
sir.
sense. Okay, here Big A was clearly bought with an income producing asset. Okay, here's the tree. Without the player, you're not going to have the goals. Alright, so that must be capital in terms of the gain. Okay, it would not be included, in gross income. But is it a special inclusion? Yes, it is. Special inclusions include things that are unrelated. Okay, things that must be included. Does it make sense?
Yes, sir.
Perfect. Right, and then if you read this, they talk about, again, intention. That's so important. Right, the intention is to create revenue. Okay, this was for what? This was for Starball. They bought him at a bargain price. Income producing asset. Starball was therefore sold in the undertaking of a profit-making scheme, which was not of capital nature. The 25,000 received Starball would therefore be of revenue. Okay, I actually would disagree with that, because I would debate it otherwise. I would have said, well, their goal wasn't to buy the player to sell them for a profit. Their goal was to buy the player to work for the club and to hopefully fit in the club. And it just so happened that this player wasn't right for the club. Do you agree? The intention wasn't to buy to sell the player. I still don't agree with that fully.
Yes.
Okay, as long as you motivate according to the rules, you'd be fine. All right, I would have motivated the opposite here for this one. I would have motivated for this to be classified as revenue in nature in terms of not being capital. Is that right?
Yes, so that's good.
Okay. All right, and then that's another question there, 4.2. Right, so I'm going to leave you just to have a look at some of those other questions. And if you have any problems with them, let's discuss them. I know I need to do quite a bit of theory still before we actually do the second assignment. What is the due date for the second assignment? Okay, I didn't get an answer. I know maybe the microphone didn't work, but I think it's like, what, 6th of April, if I'm not mistaken. That might be a different subject. I'm not too sure. Oh, 9th of April. Okay. Okay, so yeah, 9th of April is quite soon. I know there are some public holidays coming up soon.
It's 9th of April.
Yeah, the 9th of April. Yeah, I heard you there now, and I also saw it in the chat. Let me just check the... Ooh, where's the calendar? Just hold on a sec. Let me go get a calendar on the other desk. Okay. Alright, I'm looking at the calendar. 9th of April is a Monday. The 2nd of April is Good Friday. Well, Easter Monday. So actually, next week is the 26th. And then the following week is the 2nd, which is a public holiday. And then the next time we meet is on the 9th of April. Yeah, so I'm probably going to have to cover that with you next week then, because today is the 19th, right? Yeah. No, is it? What is today's date? Yeah, today's Monday.
This is the 19th.
It is the 19th, yeah. So next week is the 26th. So yeah, we'll have to discuss it then next week. Okay, so I've only covered study unit 4. Let's see what we need to look at in assignment 1, just to check that, just to get a better idea of the context in terms of the assessment. Okay, assignment 2 starts here. First semester, assignment 2, 25 marks, 30 minutes. It looks short. 30 minutes is nothing. Question 1, okay, they have given you quite a detailed question here about bad debts, which is your allowances, which is actually something we need to cover next week. That's in study unit 5. They talk about some of the the income stuff you'd probably be able to do now, based on what we covered today. Then they talk about the trading stock. Okay, yeah, this is a little bit more advanced, slightly, and then calculate the income tax liability, 20 marks. You might or might not be able to do all of it. Some of it we haven't covered yet because those are the deductions. Okay, so the deductions I will look at next week. I think maybe with the deductions I'll cover the theory next week and then do the assignment with you. The assignment looks very short. It's just 2 questions and it's written. The second question talks about what? Oh, this one you can definitely do. Okay, so question 2 for 5 marks, that we've looked at already. So you will definitely be able to complete question 2 before next week. We've covered something similar in terms of the first provisional tax payment. Don't worry about question 1. You can try it and see how you do. If you want to pre-read the next chapter's content will actually help you with the deductions.